Welcome to this explainer. Today, we're diving straight into a targeted look at the 2026 Kenya Economic Survey. Now, for professionals and analysts operating across East Africa, the headline numbers seem to tell a pretty straightforward story of macroeconomic stability. But when you look just beneath the surface, the actual signals reveal some emerging structural pressures. So, let's unpack what the data is really telling us. Right off the bat, this is the core tension we need to address. On paper, Kenya's macroeconomic indicators are broadcasting stability, which is great. Yet if we take a closer look at the underlying data, we start to see some real constraints emerging. Basically, stability at the top level is coexisting with some fairly intense pressure underneath. Let's start with that baseline of stability. In 2025, Kenya's real gross domestic product recorded a solid 4.6% growth. It's a robust, top-line figure. It gives us this baseline narrative of a resilient, expanding domestic economy. And the cost of living indicators definitely echo that positive narrative. Overall, inflation actually eased down to 4.1% for the year, mostly driven by lower energy costs and drops in specific food prices. At the same time, the central bank rate dropped to 9%. So what we're seeing is a stabilizing domestic environment, where borrowing conditions are finally starting to ease up. But here is where we see the antithesis to all that stability. We're looking at a growing external imbalance. The current account deficit widened quite significantly. It jumped from 285.5 billion shillings in 2024 up to 373.3 billion shillings in 2025. What's happening here is that import expenditure, specifically for things like industrial machinery and motor vehicles, is rising at a much faster pace than export earnings. So how does this national-level tension actually manifest on the ground? Well, let's peel back the layers and examine some specific sector signals. When we look really closely at agriculture and construction, a clear gap emerges between the output value on paper and the true underlying economic capacity in the real world. Take agriculture, for instance. The data points to a really healthy 10.8% increase in agricultural output value. Sounds good, right? But the import dependency ratio for total food products actually went up to 18.3%. The interpretation here is absolutely critical for decision makers. Rising output value does not necessarily equate to stronger production capacity or self-sufficiency. A lot of this perceived value is actually being driven by rising input costs, not pure volume gains. We see a very similar dynamic playing out in the construction sector. The headline numbers show a really strong 6.8% rebound, effectively bouncing back from a contraction the previous year. And right alongside that, there's a massive 20.3% surge in cement consumption. Now, this is largely being driven by public infrastructure projects and affordable housing initiatives. However, we have to ask, what is actually driving these outcomes? It turns out this construction recovery is heavily fueled by credit expansion. Sector loans from commercial banks soared to 184.4 billion shillings. This tells us the recovery is being driven by an expansion in credit and materials, which is fine for now, but it doesn't necessarily guarantee any long-term organic strength if or when the credit cycle tightens. And this brings us to a really critical blind spot. We need to talk about what the data does not show. Large-scale national infrastructure activity often obscures the ground-level reality for operators. This survey data doesn't reveal enterprise-level profitability. It smooths over all the regional variations across different counties. It hides the true day-to-day burden of input and financing costs. And honestly, it tells us very little about the actual quality of the employment being created. Ultimately, national-level data provides a really useful baseline, but it just isn't sufficient for making ground-level business decisions. Stability in headline numbers is highly encouraging for sure, but remember that it often sits right on top of immense structural pressure. So as you use this data to plan your next quarter, you have to ask yourself, are you planning based on the headlines, or are you preparing for the underlying reality?